Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into M&T Bank Corporation, ticker MTB, a 170-year-old institution that just posted earnings this morning that beat the street on both the top and bottom line. Lana, this is one of those names that doesn't get a lot of hype, but man, the numbers tell a story.
They really do. M&T Bank reported Q1 2026 EPS of $4.13, beating consensus of $4 even. Revenue came in at $2.44 billion, also ahead of expectations. This is a bank that's been quietly executing while everyone else panics about commercial real estate.
And that's exactly why we're here today, because the CRE stress narrative that dogged this stock for 2 years, it's finally turning a corner. Let's get into it. So for anyone who doesn't know M&T Bank, this is a regional banking powerhouse headquartered in Buffalo, New York. Founded in 1856, they've been doing this for 170 years. They operate across 12 states in the Northeast and Mid-Atlantic, from Maine all the way down to Virginia and the District of Columbia.
And what makes M&T different from your typical regional is their structure. They run 27 community bank regions, which is essentially a franchise model inside a single institution. Each region has local decision-making authority, but can tap enterprise-scale resources. It gives them speed on credit decisions that bigger banks can't match.
They've got about 22,000 employees, over 1,000 branches, after absorbing People's United Financial back in 2022. That was a $7.6 billion deal. And their bread and butter is commercial banking, commercial real estate lending, and retail banking. Market cap right now sits at about $32.3 billion.
The People's United integration is fully digested at this point. Management has pivoted from integration heavy lifting to organic growth mode, which is exactly where you want to see them in 2026.
Leading the charge is Renee F. Jones, who's been chairman and CEO since December 2017. He actually joined M&T back in 1992 after a stint at Ernst & Young in Boston, and he's been with the bank his entire career, over 3 decades. Rose through the finance division, became CFO in 2005, vice chairman in 2014, and then took the top job.
Jones is one of only a handful of Black CEOs in the Fortune 500, which is notable in itself. But what really defines his leadership is the fundamentals-first approach. He sits on the board of the Federal Reserve Bank of New York, and his entire philosophy revolves around managing liquidity, prudent capital allocation, and transparency. He's not flashy. He's steady. And in banking, steady wins.
All right, let's dig into the financials because this is where it gets interesting. MTB trades at a trailing PE of about 11.9, price to book of 1.25, price to sales around 3.5. That EV to EBITDA comes in at about 6.9.
For a bank generating these kinds of returns, that valuation is quite reasonable. Trailing 12-month revenue is approximately $12.4 billion. Net income on a TTM basis runs about $2.9 billion, giving you a net margin north of 32%.
The gross margin is impressive too, about 77%, which makes sense for a bank where the spread between interest earned and interest paid is the core business. Operating margin clocks in around 39%.
Let me walk through the quarterly trajectory because it tells the story. Q2 2025, revenue was $3.3 billion. Q3 dipped to $2.5 billion, then Q4 rebounded to $3.3 billion again, and Q1 2026 came in at $3.2 billion. What you're seeing is the normalization after some lumpy quarters.
And the profitability metrics are strong. Return on equity is 9.8%. Return on assets at 1.3%, which is solid for a bank this size. The efficiency ratio is trending in the right direction.
On the balance sheet side, total assets are $215 billion, with cash and equivalents of $1.9 billion. Total debt sits at $7.9 billion, net debt about $5.9 billion, and total stockholders' equity is $28 billion. The current ratio of 5.2 is strong, and the debt-to-equity ratio is a manageable 0.28.
Cash flow tells a good story too. Operating cash flow over the last 4 quarters ran about $3 billion in aggregate. Free cash flow was roughly $2.9 billion on a TTM basis. They're generating serious cash.
The health verdict here is positive. M&T has a fortress balance sheet for a regional bank. CET1 ratio estimated at 10.33%, well above regulatory minimums. They've got the capital flexibility to both return capital to shareholders and grow organically.
So what does Wall Street make of all this? The analyst consensus is a bit mixed, actually. Looking at the most recent 20 ratings, we've got a handful of buys and outperforms from shops like RBC Capital, Jefferies, TD Cowen, Cantor Fitzgerald, and Piper Sandler. But there's also a significant neutral camp. JP Morgan, Morgan Stanley, Barclays, Keefe Bruyette, and Woods all sitting at neutral or equal weight.
And we've seen some notable downgrades recently. Wolf Research moved from outperform to peer perform in January. Bank of America went from buy to neutral the same week. Evercore dropped from outperform to inline. Truist went from buy to hold in December. There's clearly some debate about whether the easy money has been made in MTB.
The consensus EPS estimate for full year 2026 is about $18.77, with revenue estimated around $10 billion. For 2027, they're looking at EPS of about $21.08.
The most recent earnings beat is constructive, but the sequential decline from Q4 to Q1, net income went from $759 million down to $664 million. That's what's keeping some analysts cautious. They want to see sustainable growth, not just beats against low bars.
All right, let's do this. Bull case first, and I'm excited about this one. The biggest catalyst here is the CRE normalization story. M&T materially reduced at-risk CRE exposure in 2024, cutting the concentration ratio from 183% down to 136% of capital. Troubled loans fell $400 million year over year to $1.7 billion. That overhang is lifting. On top of that, they're buying back stock aggressively, $1.25 billion in Q1 alone. Net interest margin is improving at 3.71%, and the 2026 guidance is constructive. NII of $7.2 to $7.35 billion, fee income of $2.68 to $2.78 billion. This management team knows how to execute.
Now for the bear case, and there are legitimate concerns. First, CRE concentration is still elevated relative to peers, even after the reduction. Office properties make up over 25% of criticized CRE loans, and if we get an economic slowdown, that could reverse the improving trend. Second, rate sensitivity is real. If the Fed cuts more aggressively than expected, net interest margin compresses. Their guidance already assumes modest rate decline, so there's limited upside from rates. And deposit competition remains fierce. Consumers have more options than ever for higher-yielding alternatives. Third, insider selling has been consistent. 9 transactions in the past 6 months, all sales, 0 purchases, totaling about $11.6 million. That's not catastrophic, but it's not a ringing endorsement from the C-suite either.
Let's put MTB in context against its peers. The closest domestic comparables are Fifth Third Bancorp at FITB, Huntington Bankshares at HBAN, Regions Financial at RF, and Truist Financial at TFC.
MTB's PE of about 12 is competitive in that group. Its price-to-book of 1.25 compares favorably. And in terms of market cap at $32 billion, it sits right in the middle of the pack. Bigger than Huntington and Regions, smaller than Truist. The key differentiator is M&T's CRE expertise and its concentrated Northeast footprint, which can be either an advantage or a risk depending on the economic cycle.
On the options front, we saw a pretty pronounced put bias heading into earnings. The call-to-put ratio was about 1 to 2.3, so for every call, traders were buying over 2 puts. Implied volatility on April calls hit 66. That tells you the options market was pricing in downside risk.
And in context of the actual results, the beat was modest enough that it didn't blow away the hedges. The stock opened lower, despite the beat, which tells you the market was focused on the sequential decline and questions about margin sustainability more than the absolute beat.
We touched on this in the bear case, but the insider picture is worth highlighting. Over the last 6 months, insiders have been net sellers, 9 sales, 0 purchases. Vice Chairman Gary Geisel sold nearly 900 shares in January. John Barnes moved about 39,000 shares for roughly $9 million. Senior EVP Michael Wisler sold over 8,000 shares.
In fairness, insider selling at elevated stock prices doesn't always signal bearishness. These could be planned sales for tax or diversification purposes, but the complete absence of any insider buying is notable.
Key risks to watch going forward. Number 1 is CRE. Yes, it's improving, but any economic deterioration could reverse the trend, especially in office. Number 2 is rate sensitivity. A more aggressive Fed cutting cycle would pressure margins. Number 3 is regulatory. As a large regional, M&T faces heightened capital requirements and oversight.
I'd add deposit dynamics as a fourth risk. If competition for deposits intensifies, that directly hits the funding cost line. And fifth, while the People's United integration is complete, any future M&A could introduce execution risk.
So here's the bottom line on M&T Bank. This is a 170-year-old institution with a proven management team, a differentiated community banking model, and a balance sheet that's getting stronger. The CRE overhang that weighed on the stock for 2 years is clearly fading. Valuation at under 12 times earnings is reasonable for the quality you're getting.
The metric I'd watch most closely is net interest income trajectory. Management guided $7.2 to $7.35 billion for 2026. If they can hit the upper end of that range while keeping credit costs contained at their 40 basis point target, the earnings power of this franchise will become more obvious to the market. The forward PE based on 2026 estimates is around 11.6. That's not demanding for a bank generating nearly 10% ROE.
I want to close with this quote from Renee Jones. He said, and I'm paraphrasing, M&T thinks of itself not as a community bank, but as a bank for communities, and they strive that stakeholders experience the difference. I think that sums up the culture here, Lana.
It does. And in banking, culture is strategy. The banks that survive 170 years are the ones that take the long view on relationships and risk management. Whether that translates to stock outperformance from here depends on the macro, but the foundation is solid.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. That's going to do it for our Q1 2026 earnings deep dive on Charged Alpha. I'm Hudson Thomas.
And I'm Lana Chen. Thanks for listening.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.